if you are self-employed, you have 4 health insurance options. 5 if you want to leave your job. And I am so glad that you are here because I'm going to go over each one of these options, the good stuff, some of the red flags to look for, and then ultimately who is likely to choose each of these options. Hey lovelies, it is Stephanie, licensed health agent, and because I am self-employed like you, these are also my health insurance options. And those self-employed health insurance options are the marketplace, fully underwritten plans, short-term limited benefit plans, share plans, and that 5th option, if you are just about to leave your job, COBRA. So real quick, I'm going to touch on COBRA because not all of us have that option. So COBRA is the option to keep your employer health insurance plan when you leave your job. Often the benefits will stay the same, but your premium will often jump because your employer will no longer be paying part of that for you. COBRA will only be for a limited time, which is usually 18 months, and then you will have to choose one of these other 4 options just like the rest of us. So when do people choose the COBRA option? If somebody has a pre-existing condition that they are actively treating, then their self-employed health insurance options are quite limited. And the benefits that you will have on the COBRA option will often be better. So if somebody is actively needing a surgery or under significant treatment and they can afford the COBRA health insurance, then taking that option is usually the best choice. For a specific deep dive on COBRA, what questions to ask HR, is COBRA going to be the best fit for you, and all the things to think about before you decide to leave your job, I recommend that you watch this video up here next after you finish watching this video because you are going to need all this information to make your decision as well. Okay then, now for everybody, here is the deep dive going into the other 4 self-employed health plan options. So again, your 4 self-employed health insurance options are the marketplace, fully underwritten plans, short-term limited benefit plans, and share plans. Okay, so first we have the marketplace, aka Obamacare, aka Healthcare.gov. This is the one public option because it is run by the government. Okay, so most of these plans are HMO, which means that you will need a referral from your doctor, your primary care physician, in order to see any other doctor. Also, not a lot of doctors and hospitals take these plans, and they are not nationwide. They usually stop at state lines. But preventative and wellness care are usually covered 100%. And often, more importantly, they take pre-existing conditions. They do not care what is going on with you, you can get on the plan. But because they have no limits on who can get onto the plan, they do have a limit on when you can sign up for those plans. And that is called open enrollment. And that is usually for just about a month and a half each year at the end of the year. So if you miss that open enrollment time, you will have to wait until the next year to be able to sign up for a marketplace plan. Cost-wise, they can be the most expensive of the 4 options unless you qualify for one of their subsidy tax credits, which will reduce the amount that you're paying each month based on your household income. If you do qualify for a subsidy, sometimes that can make the plans the cheapest of the 4 options. And the big thing with the marketplace is that this is one of only 2 of the 4 options that have unlimited covered benefits after you hit your max out of pocket. What that means is that once you hit your max out of pocket, that ceiling amount, say it's $5,000, $7,000, once you hit that amount, they've got it from there 100%, and they don't stop paying until the end of the year. So who chooses to go with a marketplace plan? So for most people that qualify for a good size subsidy, the marketplace is going to be the most affordable option out there. Now, the second group of people that will take a marketplace plan are those with pre-existing conditions. If you have a significant pre-existing condition and didn't qualify to get onto a fully underwritten plan, then your next best option is going to be a marketplace plan. So let's go over fully underwritten plans. So fully underwritten plans and the other 2 health plan options are all private health plans, which means that they are owned by the insurance company and run by the insurance company. Although, like all plans, they are regulated by the state. Fully underwritten plans, they are offered all year round, so you can sign up at any time, but you do have to be healthy enough to get onto the plan. Because you have to be healthy enough to get onto the plan, the benefits are often better and the prices are a lot lower than if you had to pay full price on a marketplace plan. And those better benefits include their PPO. They are nationwide. You get to choose your own doctor, whether it's in Maine or in Florida or in Texas. And most doctors and nearly all hospitals will take the plan. The deductibles can be flexible as well, and you can choose to have doctor visits, x-rays, labs, prescriptions, free teledoc over the phone as benefits before you have to pay anything into your deductible. That includes wellness, your yearly checkup. Because you have to be healthy enough to get onto the plan, you're not going to be able to get onto these plans if you have a significant pre-existing condition. But once you get on the plan, if you do get really sick or something happens to you like an accident, the plan will take really good care of you. Because this is the second option that has that unlimited covered benefits option. Again, once you hit that max out of pocket, they will pay 100% of their covered benefits until the end of the year. Now, when do people choose fully underwritten plans? There are also two groups of people that take fully underwritten plans. You, of course, for both of them, have to be healthy. But one group are people that do qualify for a subsidy on the marketplace, but can't afford to pay more for better benefits. Because we are self-employed, sometimes we can qualify for a subsidy, but still afford to pay a little bit more for better benefits. So if we are healthy, then we'll choose a fully underwritten plan. And the second group that will choose a fully underwritten plan are those that are healthy and don't qualify for a subsidy on the marketplace, which means you're paying full price for a marketplace plan. Now, if fully underwritten plans are offered in your state, and you have to pay full price for marketplace plans, it is almost 100% guaranteed that you will be paying significantly less than a full price marketplace plan with a fully underwritten plan and have better benefits. Okay, so the last two options are short-term limited benefit plans and share plans. Now, these plans have certain limitations depending on which plan you choose and how you build it out. The good things are most of these plans are PPO, which means you get to choose your own doctor. They're also nationwide, and a lot of doctors and hospitals take them. Also, some of them have benefits before the deductible, so have, doctor visits and wellness and some labs and prescription, depending on which plan you choose, again, before you have to pay any deductible. These plans can be built to be some of the cheapest that are out there, depending on how you build it out and the benefits that you choose. They have great flexibility with deductibles and the benefits that you can add or take away on the plans. Again, adjusting the price. Some of these plans will take people with pre-existing conditions, even significant ones. However, they will not be paying any benefits for those pre-existing conditions for at least 12 to 24 months. So if you have high blood pressure and have a heart attack, it's not going to be covered. If you break an arm, likely to be covered. If it's a short-term plan, then they often won't cover those benefits ever. Short-term plans are exactly that. They are short-term plans. And if that short-term plan ends in the middle of the year and you need pre-existing condition coverage, some sort of treatment of any kind, you won't be able to get onto a plan that will give you coverage until the end of the year, when you can sign up for a marketplace plan. Now, limited benefit plans, these are any plans that have some sort of limit on them, either in the amount of time, say $300,000 in a year or $1 million over the policy year lifetime, or a limit to specific benefits like $1,000 a day in the hospital. Yes, these plans can pay out really nicely depending on what happens, but just know that there is no ceiling. There is no cap where it says, hey, we've got you 100% unlimited from here. They may even have a max out of pocket, but if they have a limit at the end, say a $1 million, that means after $1 million, you are responsible for paying the rest 100%. Now, the last and fourth option are share plans, and they are their own option because they are their own type of health coverage plan. A share plan is exactly what it is. It is a pool of money that everybody pays into with their premiums, and if somebody needs to use it, then they take money out of it for the bill. It's more of a community-like feel, and a lot of people love these because of that. They are also often religious affiliated. So there are two things about share plans to be aware of. So number one is they are not covered by HIPAA, or you're not covered by HIPAA, which means that part of that community feel is that there is a monthly newsletter that explains exactly how the share money was spent. It will list your name, how much was spent, and what the coverage was for. So your personal information is neither protected nor private. It is actively shared. And number two, and this is the most important, if those share funds run out, all the money out of the pool that everybody's been pulling into goes down to zero, the company is likely to fold. And I've seen this happen where people will get a letter in the middle of the year that says, as of X date, you no longer have health coverage. We are closing our doors. And if you're in the middle of the year and you have a pre-existing condition, it's going to be really hard to find a health plan. So when do people take these plans? The short-term limited benefit plans and the share plans. If they have a pre-existing condition and they can't get on a fully underwritten plan and they can't afford the marketplace plans. Or they have a pre-existing condition and they're just trying to get to open enrollment so they can get on a marketplace plan. So in between now and that time, they have some sort of coverage. So for these four self-employed health insurance options, your best benefits options are going to be, if you're healthy, One, fully underwritten plans, or two, the marketplace. Now, if you have pre-existing conditions, your number one option is going to be the marketplace, or number two, a short-term limited benefit plan or share plan. But sometimes it really comes down to pricing. How do I find out the pricing for each of these and how they stack up against each other? Well, I am so glad you asked. Watch this video next. I do a cost comparison of all four options using hypothetical situations based on my real-world experience as a licensed health agent, finding the best options for all of y'all. And of course, you can always reach out to me in the comments. If you have any questions, please do so. So reach out to me. Watch this now, and I wish you joy.